After more than 5 years of experience with Seeking Alpha, I'm making this first review/tutorial. Do you want to know how Seeking Alpha works? I'll show you exactly what Seeking Alpha can do for you. I've been a member myself since 2021, as you can see. If you don't know me yet, my name is Jorik Vermeulen from Happy Investors. We help people with simple investing for financial freedom. And on our YouTube channel, we make countless analyses where we also use, for example, Seeking Alpha. But not just Seeking Alpha. We also create tools. We use a lot of tools. We're a company, so we have a lot of tools. Nothing an individual could afford. But for example, through Maxim, we use the free tool, the Morningstar analysis that we find under analyst ratings. And we go to Morningstar. That's one of the tools. We use fast graphs for historical valuations, including forecasting based on EPS growth. We use Zacks-Ray. We use the stock screener from Market Screener, where we have the pro version that costs about €2,000 a year. We have Motley Fool. We have TradingView as a paid program, and we also have access to the exclusive insiders, which also costs about €2,500 or dollars per year. So we have countless tools. We invest more than €10,000 per year in these, and we do our own extraction from them. Focus on selective dividend stocks and growth stocks. Check our website for our current selection. All of this, these tools and so on, are great, and we use a combination of tools that I have built up over more than 10 years of investing. From experience, from what I know works to support me. But that doesn't take away from the fact that you need to learn the principles of investing. And if I could recommend just one book as advice for education, it would be University of Berkshire Hathaway, where you learn the principles of Warren Buffett and Charlie Munger. That really is the crucial foundation for long-term investing. And all these tools, including Seeking Alpha, which is great, are only there to support your research. Success in stocks and investing only comes if you do a ton of research. So work hard, do deep dives into the companies, go through business strategies, and these tools don't give you the answers to that. But it's a super handy tool to save a lot of time. I have access to Alpha Picks, and I have access to premium access from Seeking Alpha. I don't have access to the Pro Access. That one's pretty expensive. It's on the wish list, but I don't know if it really adds that much value. You can already get a lot of value from the premium version. One thing before you continue. In our video description, you'll find special partnership links with partners I've built relationships with over the past few years. Often you'll get a discount, sometimes even a big discount. For example, with Maxim. If you don't have an investment account yet, this is one of the cheapest brokers, and it's where I invest myself as well. As I show, you get €100 in bonus on your transaction fees. So you've already saved €100 right there, and you'll also find discounts from other trusted partners I work with. I only ever recommend things that I genuinely believe are valuable to use, but do pay close attention to the costs. Seeking Alpha premium costs, with a discount, about $250 per year as far as I know. Without the discount, I believe it's $300 per year. That's quite a lot. Suppose you invest with €10,000, and you pay €300 in fees per year. That costs you 3% of your returns every year, so that's not really worthwhile. Our other analysts offer investors for €99 per year, so that's actually an even better choice. But all jokes aside, this is a great tool, and I'm going to show you exactly how it works in a moment. But do pay attention to the costs, so it only really makes sense if you have large amounts, for example from 20 or 30K upwards, to then make an investment in something like a screener. Until then, you can just follow our channel, Happy Investors, because we frequently share stock analyses to inspire further research. So one of the tools is Seeking Alpha, and I'm going to show you how it works. First, we're going to go over some basics of Seeking Alpha. We won't go into everything in great detail, but what I will show you extensively is how to analyze stocks. Because for that, I think Seeking Alpha is one of the best platforms out there. The standard features are actually as follows. On the home page, you'll find trending analysis and trending news. You go to analysis, and here you can select your favorite topic. or you click on All Analysts, and you actually see different updates here. These are what they call Seeking Alpha authors. This is an important aspect because later on, in the ranking of stocks that you find in the stock filters, the element of Seeking Alpha authors comes back. Keep in mind, these people give pay for publishing research. Some of them are excellent. I follow them myself too. I follow some analysts, others are terrible. So pay close attention to who you follow. Well, they give ratings from strong sell to hold to strong buy. That's also relevant because it will come up again later. Under news, you see all kinds of news. Yeah, it's not that exciting to follow this. You do that based on your own stocks and portfolios, right? You'll find a few different things. And maybe it's good to mention something about the homepage. What you also find are actually the latest quant ratings. Quant rating is what Seeking Alpha is known for. That's something I'll explain in detail in a moment, because this is the success factor that can help you achieve higher returns. Then, if you follow analysts, you can go to my analysts, and there you'll find analyses from the analysts you follow. So I follow a few, including Stephen Kress. He's actually the founder of Seeking Alpha. If you're just getting started or you already have a portfolio, you can of course start by setting up your portfolio. You could also set up your own screens, but you'll first do all of this as you learn how to use Seeking Alpha. When you log in and have access to the premium version, under the Find and Compare section, you'll find stocks. And here you'll actually find an overview of top stocks, selected based on factor analysis. Factor analysis is quant rating, and that quant rating is very important. Stocks are all selected based on this rating. So you'll also see it's ranked from 4.99, which is the highest score, down to 1.01, which I believe is strong sell. Well, it's really very simple. If you consistently select stocks that have a quant rating, you increase your chances of success. There are a lot of ifs and buts, and it's impossible for me to explain all of that in this short video. Investing involves a lot more than just a simple rating. But I can honestly tell you that the factor analysis, the quant rating from Seeking Alpha, works particularly well, but it's never a substitute for blindly copying these stocks. You always need to do thorough research on stocks to really increase your chances of success. Here we also see SA analyst ratings, and we see Wall Street analyst ratings. Well, those SA analyst ratings are from the Seeking Alpha analysts, which we just discussed under analysis or under my analysts. And together, they provide an average rating that ranges from a sell to a buy rating. And that's this rating over here. And we see Wall Street ratings. Those are simply from Wall Street analysts who also give ratings. In combination, you see that with top stocks, you get this selection. And in addition, here you find the factors on which the quant rating is based. Very important in this factor analysis, the way this algorithm works, is that there are different factors: valuation, growth, profitability, momentum, and EPS revision. Each factor has a specific weight in the total. And the momentum factor has a very heavy weighting within this algorithm, while the EPS revision factor does not as much. The others have a slightly lower weighting in the algorithm. I don't know exactly how it works, but I've been working with it for 5 years now, so unfortunately I can't completely unravel the secret. But each factor, like valuation, growth, and profitability, consists of different elements. So if we, for example, look at a random stock like Allianz, then under the heading of valuations we see different factors, and each section has its own set of factors. And even within each factor, there are elements that carry more weight. For example, you know that return on equity growth for the next year has a heavier weighting than another aspect, like revenue growth for this year. And that's how all these ratings work. Here, within the algorithm, we have a specific weighting, and all of it together results in a certain score. What's crucial about what I'm about to say is that this score, which is strong buy, is based on a relative score. Relative means And we see this in comparison to the sector median. So this stock is part of a certain sector. You can find that sector here. We see the sector is financials in the industry of multi-line insurance. There are only 6 stocks in the industry, but in Allianz's sector, there are almost 700 stocks. So Allianz as a stock is compared to 700 other stocks, but only within the same sector. So, basically, you can find the potentially best stocks for each sector. So, under top financial stocks at the moment, Shethel is listed. Well, I actually mentioned this stock myself in our Happy Investors community, somewhere around March 2025, and since then it has really exploded. All we did was use these screeners that I'll show you in a moment. And then you go through all those stocks based on fundamental analysis. And that's it. Here you have figures like valuation numbers. You need to know how to interpret them. That's why you need education. You can also take our courses or read good books, as I mentioned before. This is a great book, University of Berkshire Hathaway, but even then, you still need a lot more education to really understand all these things. You see growth figures, profitability, and all these factors get a certain rating. And right now, Shethel scores very high. Also because the momentum is very strong. But if, for example, the valuation starts to rise sharply like in this case, then the risk increases a lot. Still, you get a B+ here, because the PG ratio carries a lot of weight within this algorithm for valuation, since the PG ratio looks at the next 3 to 5 years and the share price in relation to the earnings growth per share. So the PG ratio is super important. The only problem with that PG ratio is that it's the EPS estimates, so the earnings per share estimates for 3 or 5 years from now suddenly drop. For example, because the company made a poor fundamental choice in their business strategy or due to new disruptive competition. Yeah, then this stock will plummet really hard, because the current valuation is very high as you can see, and the future expectations are also very high. But if those future expectations turn out lower than expected, and the higher those expectations are, the easier it is to underperform, then the risk becomes greater. So it's not like everything here is perfect. You really need to know how to select these stocks, but just having the overview of top stocks already gives you a great filter to pick stocks that can deliver high returns. For example, I personally have Carnival Corporation, which is doing very well. I also have Kindle Holdings, which is also performing very well. Thanks to SeekingAlpha, I was able to find these stocks. Then I go on to invest countless hours in fundamental analysis. So company strategy and management. You have to go through everything on the investor relations page. Annual and quarterly reports will cost you about 20 to 50 hours per stock. And if all these factors, including the other screening methods I just showed, if all of that looks good, then you select a stock to buy in your own unique way. What we do is, we're not greedy, we charge super low fees and only based on profits. So that's another core principle behind what we stand for. Simple investing, outsourcing a part of it. Well, thanks for your patience with that. Now we're going to continue by looking at how these screeners actually work and what other kinds of options you have in them. A really good starting point is the top stocks from SeekingAlpha as your first filter screening for your research. If you want to find more ideas, then you go to the stock screener. This is what I do myself. Here you'll find a number of my screens. These are links I've saved for myself with special filters that I know work really well. So, for example, I only select certain stocks based on return on equity, just as an example. I've made a separate screen for that, and I have even more like it. The standard stock screeners are set up here. Actually, a really good starting point is to begin with the top quant stocks. You have stocks that are quant, and then you get the whole universe based on factor analysis. But there are also a lot of weird companies included. For example, do you want to select dividend stocks? Then, for instance, choose quant dividend stocks or the high dividend stock yields, and here you can also see the top dividend stocks. There are different screeners, as you can see, and all of them are selected based on factor analysis. So this factor analysis is very decisive, as you can see. And for example, there are also stocks listed here. Some are overvalued and others are highly undervalued, but you won't just find that out based on factor analysis alone. For that, you really need to do a deep dive. Besides that screener, there's also an ETF screener. We'll cover that in a bit. You could also customize these kinds of screeners yourself. That way, for example, you get a screener like the one I use for myself, small cap selection. Here we see sizzle at the top again, and here I've set up separate filters for myself. For example, net income margin has to be above 40%. Return on equity needs to be above 10%. Return on total capital has to be above 10%. And this way, you can gradually put together your own filters. Very handy. And these are all just tools to save you time. You can also see that because I've applied stricter filters, my selection is smaller. And I've also deliberately included stocks in my screening method that don't score a strong buy on factor analysis, but for example, a hold. Because a yellow color means a hold, and it stays a hold from 2.5 onwards. Why do I do that? Because, for example, this is just a good example, and it's a bit improvised. But Crocs, for instance, currently doesn't score a strong buy on factor analysis. But Crocs can still be a very good investment. How do I know that? Well, by doing a lot of research and spending countless hours following the market. But what's the issue with Crocs? Well, the valuation is relatively cheap and it has strong profitability. Suppose you want to select stocks that might be undervalued but could strongly outperform in the long term. Then you look for high-quality stocks that are undervalued with a margin of safety. Yeah, you only find those very rarely. But if you do this kind of thing a lot, sometimes you find gems. Crocs isn't one of those gems, but Crocs is still a stock. Just as an example that is interesting, that currently doesn't get a strong bias from factor analysis, but could still be a very good investment. So, factor analysis doesn't tell you everything. The same goes for a strong sell. Sometimes, it can actually be the right moment to buy in. For example, with Crocs, you see that it's dirt cheap, that right now the price-to-earnings ratio is still below 10. Only the PEG ratio is estimated at 2.25. How is that possible? For example, because growth is estimated to be lower, but this is super important to understand. Here you see estimates from analysts, often also based on management analyses, and that's why the screener is populated. But here, for example, the EPS estimate for the next 3 to 5 years is only 3.7%. Where do the opportunities lie if you've been following Crocs for a while? If you know the company really well? For example, a new CEO is coming in who is very strong. A new strategy is being presented. You've done a lot of research on this, and you estimate that it could work really well. Then this data is basically a bit out of date, and you know it's just a matter of time before the company starts performing better. So with a lot of research, you can also select many stocks that might not score as a strong buy, but could still be a great investment. That's why, actually, right? The summary is, use it as a tool to save yourself time. Don't use it as the decisive factor to buy purely, and solely based on a strong buy rating. So here, for each stock, we see a lot of information. First of all, when you click on a stock, you can also look it up using the search bar. Let's take ASML as an example. Not all European stocks can be found on SeekingAlpha. That's a limitation. It's mainly focused on US stocks and very well-known European companies, which does include ASML, for example. ASML currently doesn't score a strong buy, as you can see. That mainly has to do with the high valuation. I actually agree with that, to be honest. You look at the page, and you see a number of things here. And if you scroll down, you'll actually find a summary of the company, the revenue trends, the earnings per share estimates, and this is basically all a summary of what you can dive into in more detail. If you go to ratings, you'll find the history of the Quant Rating. ASML has only been added recently. Like I said, these stocks aren't always available on SeekingAlpha because they're from Europe. You almost never find companies from Asia on SeekingAlpha unless they're really big, like TSM, Taiwan Semiconductor. But that one also has a Nasdaq listing, so that's a bit different. You'll find the rating, the quant rating, and its progression, and that's interesting, but it's something you'll need to learn about. You can see the SeekingAlpha analyst ratings and the Wall Street analyst ratings. You can take your time to look at this yourself. You also see the price targets and the price target versus actual price trend. Financials is very rich in information. It goes back more than 10 years, and here you'll find the income statement. So that's revenue and costs. That gives you cash flow, so earnings from continuous operations. That's the cash flow, and then you get the net income. And here you actually see some other things, like for example, what is the current EPS? What is the EBITDA? And so on. What matters when analyzing statements is that you need to analyze the long-term trend. From that, you can filter out certain factors, such as what is the revenue growth? Is it continuously increasing? What is the profitability? Is that continuously increasing? And those factors, you actually find them reflected in metrics like revenue growth, where over the past 5 years you see a revenue growth of 20% per year for ASML. Well, that's really good. With profitability, for example, you can see whether the profit margin has increased compared to the 5-year average. That's a positive trend. Return on equity is very important. ASML is a high-quality company for a reason. It's extremely profitable, and you can see that in the numbers. Return on equity is particularly high, averaging 50% over 5 years, and a return on total capital of 26%, so very high profitability. And this kind of it's really about the trends. Once again, let's take a small step back. What is the catalyst or the driving force? The company and the driving force behind this whole thing? That is, of course, business strategy. What does a company do? What choices do they make? How do they invest money? So how efficient are they with capital allocation? And do they keep working on what they call a competitive advantage? A strategic advantage over competitors, allowing them to maintain high profit margins? And can they keep this up for another 5 or 10 years? So that profits not only increase, but ideally grow at an accelerated pace. And if you can figure that out for yourself, then you can basically calculate an intrinsic value using the discounted cash flow method. And for that, you use free cash flow. But these are a lot of specialized terms. Not familiar with them? No problem. Just follow more educational books. Watch videos from people you trust, who are experts and that sort of thing, and then you can learn all of that. Income statement, balance sheet, so the balance with cash and also long-term debts. You can find short-term debts as well. And of course, super important, the cash flow statement, where you also want to look at the free cash flow. A little trick, you have the cash from operations, and what you subtract from that is the CapEx, the capital expenditure. That's, for example, spending on machines. And if you take the cash flow from operations and subtract the CapEx, then you get the free cash flow. And what you want to see is an upward trend. There are also just metrics like leverage, free cash flow, and things like that. Free cash flow per share. That's the one I was looking for. Then you also see how much free cash flow there is per share. The higher, the better. And you'll find some other things as well, like repurchases of common stocks, that lets you see whether the company is buying back its own shares. And this year, they're doing quite a lot compared to other years. And of course, that's a sign of how management handles their money. You also see the dividends they pay out. All of this falls under the topic of capital allocation. The company also has a policy for that. You need to know that. You need to understand it. You need to know how efficiently they use their money. All of this is to determine whether this will be a successful long-term investment or not. Coming back to that factor analysis absolutely does not work perfectly for the long term. Now, there are a lot of features, as you can see on Seeking Alpha, and you really need to master most of them and learn to use them yourself. Besides financials, you also have earnings. We also have momentum. We have peers. Those are comparable companies you can use for comparison within the same sector. You see options, and you also see charting, so graphs. And here you can add metrics and actually perform all kinds of analysis. Well, it's important to mention that, in my opinion, the most useful thing is that you can, for example, look at a sector, and if you want to know what the top technology stocks are at the moment, you can find that out. And you immediately get a quick overview of the stocks. We also selected Celestica in our analyses. It performed extremely well, and we were actually among the first to discover Celestica. Thanks also to Seeking Alpha, back when it had just been rated as a strong buy. That's when I started analyzing the company. It was in the right sector. Does that mean the sector also had momentum? And that's very important for success. If you have strong companies that are also in strong sectors, that significantly increases your chances. Well, there are a few things, and I think it's all explained in a very easy way. Do you have any questions about it or any additions? Let us know in this review. Of course, there are a lot of additional points. It's not very easy to give a short review about how extensive this program actually is. For dividend stocks, Seeking Alpha is also very useful. For example, if we go back to the stock screener, what we find here is an option for top quant dividend stocks. And it's not just based on factor analysis, but also on 111 factor analysis specifically for dividends. So here you see different metrics, namely dividend safety, dividend growth, dividend yield, and dividend consistency. What's the trick? All these stocks score high on the factor analysis. For example, here we see Philip Morris. At the moment, Philip Morris scores very high on the factor analysis. That doesn't necessarily mean it's the best choice from this list. It just also scores high on certain dividend factors. So let's go to Philip Morris. We can analyze Philip Morris based on these different aspects, and here we actually see that it scores very well. High on profitability, strong on momentum, and strong revisions, but the valuation has become less attractive. You can also see from the price chart that Philip Morris has risen a lot, and it could very well be that Philip Morris is perhaps overvalued. Well, then I can quickly see at a glance that the price-to-earnings ratio is 36, and for next year it's 24. With a PG ratio well above 1, a price-to-sales ratio far above Philip Morris's 5-year average, and a price-to-cash flow ratio well above 15, which is also the 5-year average for Philip Morris. And the dividend yield is only 3% now, because the share price has risen so much. So even though Philip Morris is currently rated a strong buy, and the factor analysis scores well, I can already say from this quick overview, because I also know Philip Morris, that it's probably overvalued. So you always need to know what the intrinsic value is, and don't just speculate. However, it is possible that the company continues to surprise based on momentum. And that's why the factor analysis has predictive value. But it's not an absolute decisive criterion to say, I'll always be successful if I only buy stocks with a strong buy rating. But Philip Morris is a dividend stock, and we were going to talk about dividends. So let's go to the dividend section, and here we see an overview. They call this the dividend scorecard, which is a rating based on safety, growth, yield, and consistency. Here you'll find a summary, but let's take a closer look at the different factors, each of which has its own weighting. And really, all of these together should lead to the question, is this a good, stable, and reliable dividend stock or not? If yes, then it will show up in the overview of top dividend stocks in the Quant Rating. For example, the dividend yield is one factor, and it looks at, okay, what is the dividend compared to the sector median? It's always a relative comparison. Keep in mind, a relative comparison. So here we see that the dividend yield for next year is estimated at about 3%. Well, that's still higher than the sector median, so it gets a B-. Dividend growth is an A-, So it's doing very well in terms of dividend growth. Why is that? For example, because factors like EPS and free cash flow are expected to grow, and those are favorable factors for being able to increase your dividend growth. The dividend, actually the ticker, as you can see, it's 3%, and for next year, a dividend growth of 4% is expected. And this is also how you find factors of dividend safety, mainly the payout ratio and dividend consistency, which you actually find under history. And here you can see how many consecutive years the company has paid dividends. So, consecutive years of dividend payments. And how many years in a row it has also achieved dividend growth, so that it has paid out extra dividend, and that year after year. This is a really strong performance from Philip Morris, which has paid dividends for 16 consecutive years and has increased the dividend, so you don't see that very often. So Philip Morris is a great dividend stock. Only in this case, specifically, the share price has already risen sharply, so I don't think it's the right time to buy. But actually, maybe now is indeed the time to take profits. But we're not going to discuss individual stocks here. I think it only makes sense to do this if you have more than 20K in assets and you want to actively invest in stocks, then SeekingAlpha is definitely worth it. It saves you a lot of time on research, and it works really well if you strictly stick to the quant rating. But you still always have to do your own analysis, do some filtering, and make a selection from all these top stocks and top ETFs. And that changes constantly, so you do spend quite a bit of time on this. On the other hand, it saves you a tremendous amount of time, and so my final verdict or conclusion is that SeekingAlpha is actually one of the best stock programs for selecting potentially better ETFs or stocks. And I can honestly tell you, with 100% honesty, that this is definitely one of my favorites among the tools I use and have used in the past.